Hey everyone! Welcome back to our channel where we make sense of the most complex events in finance and economics. Today, let's jump into a burning topic, the recent market crashes in Japan and the USA. You might be wondering, why did a crash in Japan lead to a meltdown in the US markets? It's a story of global interconnectedness, surprise moves by central banks, and a lot of investor panic. So, buckle up, because we're about to break it all down for you. Let's start by unpacking what exactly happened in Japan. On August 5, 2024, the Nikkei 225 index, Japan's primary stock market index, suffered a dramatic drop of 12.4%. This wasn't just any ordinary bad day on the stock market, this was Japan's worst single-day decline since the infamous Black Monday crash of 1987. To put it into perspective, the Nikkei lost about 4,451 points in just one day, wiping out a staggering 113 trillion yen, or roughly $792 billion, in market value. So, what triggered this financial disaster? It all started with a surprising move by the Bank of Japan. For years, Japan had maintained ultra-low interest rates to support its struggling economy. But on July 31, 2024, the Bank of Japan shocked the markets by announcing an unexpected interest rate hike for the first time since 2007. This move sent the Japanese yen soaring against other major currencies. Now, you might be asking, why does a stronger yen matter? The answer lies in the world of carry trades. This is where investors borrow in a currency with low interest rates, like the yen, and then use that money to invest in other countries with much higher interest rates, like US. When the yen suddenly strengthens, the cost of repaying those loans skyrockets, forcing investors to sell off their assets to cover their losses. This is what we saw happen in Japan. Investors began a mass sell-off, leading to the massive drop in the Nikkei. But that's not all. Japan's banking sector was hit particularly hard, with banking stocks plunging by 17%. Major companies like Tokyo Electron, a leading chip equipment maker, saw their shares drop by 18.48%, and tech giant SoftBank Group lost a staggering 18.66% in value. The broader Topix index also fell by 12.2%, confirming that the crash wasn't just limited to a few sectors, it was a broad market sell-off. The ripple effect on the global markets. So, how did this massive sell-off in Japan impact the rest of the world? Well, it all comes down to how interconnected global financial markets are. When a major economy like Japan experiences a shock, it sends ripples across the globe. Investors around the world started to panic, leading to sell-offs in other major markets, including Europe and the US. In Europe, the Stoxx 600 index fell by 2.4%, hitting a 6-month low. But the real impact was felt in the United States. On the same day Japan's market crashed, the Dow Jones Industrial Average dropped 951 points, or 2.4%, the Nasdaq Composite fell by 3.1%, and the S&P 500 declined by 2.7%. Adding to the panic was some disappointing economic news from the US. The jobs report released just before the crash indicated that the US economy might be slowing down, sparking fears of a potential recession. Investors were already on edge, and the shock from Japan pushed them over it, leading to a massive sell-off in US markets. The technology sector, a domino effect. The tech sector, in particular, took a significant hit. Many investors who had borrowed in yen had invested heavily in US tech stocks. When the yen strengthened, these investors were forced to unwind their positions, leading to sharp declines in tech giants like Apple, Microsoft, and Tesla. The Nasdaq Composite, which is heavily weighted towards tech, saw its biggest one-day drop since the start of the year. This sell-off was further exacerbated by existing vulnerabilities in the tech sector. Over the past few months, tech stocks had been riding high on the back of AI-related investments, but these valuations were already seen as stretched. The sudden wave of selling pressure caused these stocks to plummet, dragging down the entire market with them. So, what does this all mean for the global economy? The crashes in Japan and the US are a stark reminder of how fragile the global financial system can be. When major economies like Japan and the US are hit, the effects can be felt worldwide. It also underscores the risks associated with highly leveraged investments, like carry trades. When these positions unwind, they can cause massive waves of volatility that spread across the globe. Moreover, the synchronized decline across global markets raises concerns about the potential for a broader economic slowdown. With central banks around the world grappling with inflation and economic uncertainty, the road ahead looks rocky. Analysts are now watching closely to see how these markets will stabilize in the coming weeks and what measures, if any, central banks might take to calm the situation. Will we see further rate hikes, or will central banks step in to provide more support? Only time will tell. Thanks for sticking with us through this deep dive into the recent market turmoil. If you found this video informative, make sure to give it a thumbs up, subscribe, and hit that notification bell so you don't miss any updates on the global economy and financial markets. Let us know in the comments how you think these crashes will impact the economy in the long run and what you're doing to protect your investments.